Hello, everyone. Welcome back to First Step Investor. Today, we have an exciting topic for all the beginners out there: 7 steps to understanding the stock market. Whether you're new to investing or looking to sharpen your skills, this easy-to-follow guide will help you navigate the world of stocks without drowning in confusing jargon. So, let's dive in. Stock market basics. Why to invest? First things first, let's talk about why you should invest in the stock market. It's not about some mystified secret or get-rich-quick scheme. It's about harnessing the power of compound interest. Investing in stocks allows you to unlock the magic of the market and slowly build wealth over time. Just imagine, saving $500 a month for 40 years could turn into a substantial $2,655,555 with average stock market returns. That's the key to your success: understanding compound interest. Understanding how the stock market works. Now, let's demystify how the stock market works. A share of stock represents part ownership of a business, and when you own a share, you get a claim to part of the profits. The stock market is where these ownership stakes are traded. Investing in stocks over the long term allows you to participate in the growth of the economy. Remember, the market moves up and down, but when held over the long term, the chances of gains are almost guaranteed. Learning how to invest in stocks. So, how do you get started? Buying your first stock is like taking your first step into the market. It gives you a sense of empowerment and excitement. Opening an account with a reliable broker, such as Charles Schwab, Fidelity, or Merrill Edge, is your first move. The process is easy, and you can't go wrong with any of these options offering commission-free trades. Remember, the key to investing is just getting started. Learn about stocks with the PE ratio. Now, let's delve into understanding stocks with the price-to-earnings (PE) ratio. This ratio measures how much you are paying for a company's earnings. A higher PE ratio generally means a more expensive stock. It's one of the best tools for quickly measuring how optimistic or pessimistic the market is on a stock. Knowing a company's PE helps you understand how much the market likes the stock. 2 stock market factors to trade on: PB and PS ratios. For more reliable indicators, we turn to the price-to-sales (PS) ratio and the price-to-book (PB) ratio. These ratios can be more stable indicators than PE because revenue and book value fluctuate less than earnings. A lower PS is usually better, and buying stocks with low PB ratios means you're buying close to or below their book value, minimizing downside risk. Finding the best stocks for beginners, dividends and growth. Moving on to finding the best stocks for beginners, dividends and growth. Dividends create compounding interest, and reinvesting them is a fantastic way to utilize the power of compounding. Calculating a stock's dividend yield and payout ratio is crucial. Additionally, focus on earnings growth, aiming for around 5 to 10%, indicating a stock with a bright future. The best way to avoid risk in putting it all together. Lastly, to avoid risks, watch out for companies with too much debt. The debt-to-equity ratio is a common measure of risk, and a ratio below 1 is generally preferable. Congratulations, you're now ready to start investing in the stock market. Remember, slow and steady wins the race. Don't worry about mastering it all at once, learn over time. That wraps up our beginner's guide, 7 steps to understanding the stock market. I hope you found this guide helpful. If you did, please give it a thumbs up, share it with your friends, and subscribe for more content. If you have any questions or topics you'd like us to cover in the future, drop them in the comments below. Until next time, happy investing.